And then we'll, get.
You can't see me.
नहीं एक्सटेंड किया ना वहाँ पे
Okay,
ये करना डुप्लीकेट करना तो
नहीं sound अभी आ रहा है ना?
मेरे को देख
So now, tell us about your company idea. Boy, you're part of the company
Yeah,
too? Good,
yeah.
good.
So basically we're using natural patented technology to create a better smoke gas detection system that is needed in the roof. It also has a built-in air quality factor to monitor, like harmful particles in the air, like dust, and even has the potential to go a step ahead in detecting like fires.
And what is the competition like in that area? You would imagine that that's a very active area. Is the NASA device the advantage that you guys somehow have?
Yeah, so the NASA technology, one advantage is allowing us to have all this other like competitive edge. For most detectors that are in all homes and buildings only classify either smoke or carbon monoxide. And that's it. You don't really have a wide range of particles that it can detect. It's usually one or the other. And there's not really any, or there's not widespread air quality, indoor air quality monitoring, or a network that takes that data and puts it out to the public on, what is in the air and how it affects people.
It's very topical and part of what we hope to cover is both, but will tell you how to apply to them, what criteria they're looking for, and that would be to really encapsulate your ideas and apply to them. So, what do you think, Bala? Should we start?
Yeah.
Or okay, great. Well, welcome everybody. The audience is sparer than we had anticipated based on the registrations, but hopefully that will indeed come. It's a real delight to welcome both the Boston BII, or the Boston Impact Initiative, and Highmark Capital to this. Both of you, both the funds are very aligned with the direction that UMass Boston in particular is taking, and really aligned with the populations that we serve. So each fund will tell you a little bit about their mission, what they hope to agenda in this community and with their fund focus, and what criteria they look for in funding the companies that do apply to them. And beyond that, of course, engage in Q&A and ask the questions specific either to your idea or to other things on here. Okay, so without further ado, then let me introduce BII and Henry or Becky, whoever you decided to take forward. She's the founder CEO of BII. Founder, okay, CEO. Okay, all right, there you go.
Thank you so much. It's exciting to be here. Henry and I came a couple weeks ago and learned of the Friendship Development Center and didn't know this was here. So this is like a fabulous asset to the university and hopefully for all of you. So do we have a way to project?
Yes.
Is already there?
I'll go through the slides as you talk, and I can talk to whichever you want to. Let's see.
We just sort of admit.
Oh.
Yeah, thank you.
So while Henry's doing that, I'll introduce myself and I'll let him introduce himself and we'll go to the slide deck. So I'm Betty Francisco. I'm the CEO of Boston Impact Initiative. I joined about 2 years ago. And I was prior to that a lawyer, a business lawyer for many years, about 20 years, working on venture capital, private equity, startup transactions. So I represented the whole gamut of venture capital investors, PE, public-private companies as a deal lawyer, basically. And that's kind of how I learned this whole world of how capital flows to certain markets and certain people. I then decided about 15 years into it that I wanted to start a business. And I did that. So I took a break from law. I thought I was going to retire from law, but I took a break. I started a fitness business and then started angel investing as well. But with a particular focus on investing in women founders, as well as businesses owned by people of color. That was sort of my interest and my desire to help bring capital, especially where it was most needed and where entrepreneurs and founders felt like they were very under-resourced. So I was looking specifically for those kinds of companies, those kinds of founders. And then I came across BII, Boston Impact Initiative, in 2018, where the founder, who's her name is Deborah Freed, she started BI 10 years ago now. This is our 10th anniversary year. And her focus was trying to create a stream of capital, an impact fund that was specifically place-based, so investing in a place. Our place was Boston, the greater Boston. And with this thesis that you could invest blended capital, what we call integrated capital, equity, debt, grants, all together using different transaction types, the whole gamut, which is different from how private equity and venture capital works. Which is, one type of capital with a very focus on high growth enterprises. This is looking at, how do we use capital to help address our economic injustice, racial wealth inequality issues. And so we'll get into this in a minute, but that's how BI started. I came into it in 2018, being invited to the investment committee. So I got to make decisions about who gets to invest, who gets investment from us, and then in 2021 was invited to join the organization as a full-time staff. So that's been my journey. We'll get into it, but we launched a fund in the middle of all this, and we're raising the $20 million fund, and we're investing in different kinds of companies now that we'll share more about. But it's been an incredible journey, like literally a full career transition. And then Henry, you want to introduce yourself?
Sure. Hi, everyone.
I'm sorry that I'm.
Oh, no, not at all. Henry Noel. Henry Noel. I've been in the finance for well over 20 years. Always had in mind, how does a company really fit in? And what more can they add to society? If we think of, society, big picture, and companies more and more being citizens of society, how much more can they contribute? And beyond how much can they contribute, how much more should they contribute? So really thinking about it from that perspective, again, this is back in the early 90s. At the time, I was a bond analyst for a buy-side firm in Wall Street, and we had a small fund that was off to the side where it was only some quirky teachers that invested in that fund. And essentially, it was a social bond fund, where what they were doing is screening out bad behavior or bad companies. They call them bad. So they would screen out gun providers or arms manufacturers, screen out oil and other big, tobacco and things of that nature. This is early 90s. Fast forward 20 odd years, and impact investing is a term that's coined now. And it's now the idea of, well, beyond just financials, what can you do, for planet, people, and profit? So you really triple bottom line. That was the coin, that was the term before impact investing. So after I left firm in New York, my transition was, again, I started working as an intermediary, raising capital primarily for small businesses, making introductions happen, marriages between those seeking capital and whether it's an angel investor, institutional investor, or a corporate, marriage of sorts happen, and doing that for quite some time. In that, we really started focusing in on, again, social enterprises and businesses that were looking beyond just financial return. What more are you adding to the situation, to the conversation? Left that and started a fund to invest in frontier markets. Primarily, I was looking at the country of Haiti. This was in early 2014. And we spent 5 years there basically developing that market, developing that fund, and really doing a lot of education for investors, teaching them about the risks and opportunities in that frontier market. Long story short, it didn't work out because, as we see, geopolitical situation went a different direction on us. So we weren't able to continue with the fund. But what was interesting there was, again, the idea of how do we bring the right solution to that entrepreneur at that time. you'll find that a lot of companies right now, or a lot of investors, who are investing into funds, they want to see, okay, well, are you an equity fund? Are you a debt fund? Are you a mezz fund? And they're very, very specialized. As we get into emerging markets, and we can look at the current small businesses in the US as domestic emerging markets, it's less so specialized. And it's more so where you're trying to determine what best fits this company at this point, and can I have a solution for them? And so you'll see later on, we talk about it a little bit as far as integrated capital. That's the approach we take, where everything from debt all the way to equity, everything in between, we try to provide that for that customer, for that entrepreneur at that point in time. And that's really what drew me to BII, because that's what we're doing here. Same idea that I had in Haiti as far as the integrated capital approach. So,
All right, so we'll tell you a little bit, how much do we have?
25 minutes.
So, so what do? So we are a nonprofit impact investment fund. Our focus is on place-based impact investing in order to put racial in Massachusetts. Our original place, as I mentioned earlier, was we started with this premise that you could use what we call integrated capital. So remember, all the tools in the toolbox, debt, equity, grants, and within debt, right? You might think debt is a loan, but it's also receivables financing, contract-based financing, royalty. And then you look at the spectrum of equity, right? Preferred stock, saves, convertible. So it's using all those tools and looking at who provides this, right? Not everyone can do debt, not everyone can do equity. Very few organizations or institutions do both, and are able to blend those capital types in a way that is really entrepreneur friendly. So this is part of what BI was trying to test out. And so the impact investing piece of what we do is impact can mean a lot of different things for different funds, right? So some funds are climate focused, some funds are focused on gender equity. Ours was one of the first funds in Massachusetts focused on racial and economic justice. How do we shift some of the existing inequities that persist in our ecosystem? And that's partly who gets capital access. How do we look at underwriting somebody, right? So when we evaluate doing diligence, traditional institutions like a bank are going to look at your credit score. They might take collateral from you. We're trying to do more entrepreneur friendly interactions. And so we will take time to develop a relationship with you and not use a cookie cutter approach to underwriting and doing a risk analysis. So all of that is using capital in order to shift who gets it and move it in a way that drives racial and economic justice in order to create more sustainable. And so the other piece around what is integrated capital is the financial part, right? The money that you need to start, launch for your business. But think about the other things that we need when we are starting up. We need what we call social capital. We need knowledge capital. So knowledge is how do you run a business effectively, right? What are the things you need to know? Maybe you're industry specific, right? But it's also all the connections, the advisors, the mentors, the people that can do open doors for you. That is social capital, and that's a significant part, and I would argue an even more important part to the financial capital. And then more recently, we talk about political capital. Political capital are the relationships you need with people in power, right? So government. Sometimes you are in highly regulated businesses. Who do you know, right? That's going to help you navigate a regulatory environment. Some of that involves building your political power within communities. And then our ultimate goal, right? So we do this, we are investors, but our bigger goal is to transform the field of impact investing so that racial and economic justice becomes the norm. So when we're looking at capital, and especially in the impact investment world, and we're going to throw out some terms at you where you're like, well, that's like what a venture capitalist does. We operate very differently from venture capital, even though we might be investing in companies and taking an equity stake. Our whole goal is to use these transactions to pilot and innovate ways to actually shift money and power. So you'll learn a little bit about this in some of the cases. I talked about the heart and soul of BII is using integrated capital as part of what we're starting to coin this term solidarity finance. So a lot of our work is moving the kinds of models and structures within the solidarity economy. So solidarity economy looks at a very different world beyond capitalism, a world where we value interconnections, relationships, mutuality, we value and support our environment. We're not looking at extraction, but at sort of regeneration. And so it's a really different way of looking at how capital can be used. And so we're leveraging on the investment side. So remember, we're an impact fund, we're in nonprofit. So we leverage philanthropic capital to help support our investing activity and our operating activity. And then integrated capital, so refers to the capital we need to invest, and then also what we push out. So the blended capital approach. I'm gonna go through the history very fast. We started in 2013 with a pilot fund that was very greater Boston focused. We invested $3 million into about 30 enterprises. And then proved the point that you could do this kind of hyper local investing and get paid back. Basically, you could do this and not lose your money, and you could actually have a deep impact in your community. And some of the impacts, well, we'll get into the impact in a minute. But that point led us to then launch a first fund. It was intended to be a $10 million fund back in 2017. We ended up raising 7 and hadn't fully deployed that 7 by 2020 COVID fund. So we stopped fundraising because we needed to get that money. And so that first fund of 7 million was fully deployed last year into about 50 enterprises, both nonprofits and for-profits, mostly for-profit enterprises. And then what we started to learn about this kind of investing was that we needed to share this knowledge with our greater field. We kept getting asked, how do you do structured equity? How do you actually create a royalty finance deal for, a business that has very consistent revenue? How do you do that? The field started asking us that. And we said, why don't we start to push this out through cases? And also, how do we train other people to deploy capital this way? So we launched a cohort program of emerging fund managers in 2020, 2021, 18-month cohort, 33 emerging fund managers in different cities across the US. And part of that was to help launch funds like BII, giving people the tools, the knowledge, the practice points for launching something similar. So about 12 funds at this point have launched. And that's replicating a similar approach to BII and others. We then, when I came on board in 2021, I came to start fund number 2. And so we've launched that last year. We're raising 20 million and have already raised 4 and invested 2.3 million. So that's the history. Super quick, if you think about what we do, we invest. So integrated capital is our investing activity, fund 1 and 2. And then our field building work is educating the field on how do you do this kind of investing, impact investing with racial equity, economic justice focus. And then advocacy is sort of our next future work stream, because in order to change what we call the system that perpetuate ongoing inequities, we have to do that from a policy perspective. So BI is creating a policy framework that addresses how do we create more capital flows to entrepreneurs of color, communities of color, as well as some changes around real estate. How do we propagate more community ownership? And then I'm going to leave Henry to go through a lot of that.
Sure. So as we just saw right now, we are the lab. We're the ones out there going out there and trying to make different creative structures, succeeding sometimes, failing sometimes, really trying to understand how do we make the integrated capital approach work for our entrepreneurs. we're that lab, and then we're going out and teaching that to the field. With Fund One, we, as Betty said, it was $7 million fund, we raised or invested $7.7 million, 860 of which is grants, 6.9 regular traditional financing. You'll see that about 60 or 70% was debt, grants 860, and equity 1.1. And you'll see also that it was pretty well diversified as far as industries. So we're industry agnostic, and really it's from a thematic perspective that we're trying to understand where we want to make an impact. But we're industry agnostic for the most part. Fund One's impact. If you don't measure it, can you really say that you care about it? We try to measure we measure these things across all of our companies because we're trying to really understand what it is that, what impact we are able to make. So ownership percentage, we're looking at 67% of the portfolio is owned by people of color, 38% by women, and 31% by women of color. Jobs created, 80% held by people of color, 1,415 jobs created. Another thing that we're very interested in is living wages. Again, we're interested in the power and voice of the employee workforce. That's another impact that we're trying to measure and to really look at. 79% of that portfolio workforce are paid above or at living wage. Keeping in mind that minimum wage is $15 an hour. Living wage in Cambridge, I believe, was $23, Betty, recently. 24 in Boston. So it's kind of crazy, you know, looking at what $15 an hour gets you is you're not able to live livable wages, you know, literally, you're not able to live in these areas on that salary. So really pushing companies towards livable wage. Also, we measure follow-on capital. So for every dollar that we've invested in, how much money do we bring with us as far as introductions that we've made, other investors that have invested alongside us, and monies raised in those specific rounds. So about $13 for every $1 that we've put in. Worker ownership is something we're very interested in as well. So worker power and ownership. We're looking at co-ops. A lot of times we look at supporting cooperative ownership. And again, 32% of the portfolio provides ownership opportunities, and 29% for people of color, 25% women. From Fund One, we moved on to Fund Two. One of the big learnings that we had from Fund One, as you recall, 70% of Fund One was invested in debt. One of the things that we saw was that other CDFIs and other friendly or more friendly investors were investing a lot of debt products, and the market really wanted some equity. So we decided with Fund Number Two that we were going to raise a $20 million fund. I'm targeting about 40 to 50 investments. It's going to be a 10-year fund based in Massachusetts here and focused on the Northeast and upstate New York. And that this fund will be focused more so on patient equity. Again, what was the market needing? What were entrepreneurs asking us? One of the things, so there's different types of equity. I'll segregate it into equity for the masses and equity for traditional VC type companies. Equity for traditional VC type companies, populations that we were targeting and interested in didn't have the traditional friends and family deep pockets to go to for their equity rounds. So we're looking at how can we fill that slot. Equity for the masses, you'll see that's a little bit different, where that's not the traditional company that will be able to raise money from a venture capital firm. They don't have the growth trajectory. They're not looking at the same type of growth patterns. It's not the same type of idea. It's not necessarily your mom and pop shop either. It might be a manufacturing shop. It might be a smaller business that is more predictable as far as their growth pattern. That's not going to get to 100 million in growth. But these small businesses are, as everyone always hears, the backbone of our economy. So those are some of the companies that we were trying to understand, how do we develop an equity product for that type of company? As far as investment themes, what we're looking at is, again, I mentioned that we're not looking at any particular industry, we're industry agnostic, but we are very interested in a few themes, starting with how do we build climate resiliency in our communities at the local level? How do we build climate resilience there? And how do we help that ensure that all the inner cities are getting the memo, if you will, of climate change and are not left behind and are part of that green transition, part of that or ensuring that we make it a just transition so everyone's participating. So we're very interested in that climate resilience piece. And tying into that, we're also interested into diversity in industry or diversifying of industries. So we're looking at what are the industries that are out there that are growing, that are potentially industries of tomorrow, that are not well diversified. How do we get those diversified? How do we support Black and Brown entrepreneurs to get into those industries, into those fields? Beyond that, how do we create pathways for employees? Are those companies that Black and Brown founders creating, are they creating pathways for employees to grow in those spaces as well? So that 10 years down the line, they are well diversified and we don't see the lack of diversification of ethnicity in those spaces. In addition, please.
No, on this third bullet, worker power. So often we think, we're taught, especially in higher ed and business school, we're taught that creating worker power, unionization, those are things to avoid, right? Like we run away from them. We have like union mitigation strategies. That's at least how I was trained. And BII is really trying to build like a voice, worker power in the sense of decision making. And this is a really different way of viewing things, right? We often don't give employees power and voice. And so there is, some of you may have heard the term the silver tsunami, right? There's this huge trend right now. Lots of businesses are going to start to transition in terms of their ownership and leadership, especially family-owned businesses, if no one can take them over. And inevitably they'll either close or they'll be sold to somebody for their parts. And will create a big loss in community. And what people don't often think about is what if the employee base or the management team survive and build? How do we create a pathway for that? Right? Because they've been there building that all along. And how do you do that? It takes a lot of preparation, but that is something that is there's a trend right now when you look at our demographics towards this, and it is an opportunity to actually start to shift power for the employees. It's a really different way of thinking about yourselves too. Like as you're building your businesses, we want to encourage you to think about, what happens. Like, do I want to build this to sell it and make a lot of money, or do I want to build it to create a sustainable asset in my community?
We're going to come around to the questions.
Just wanted to comment on that, regards to shared equity.
Yes.
For employees, a lot of businesses, I mean, if you give them that shared equity, you find who your management teams are in that situation.
Absolutely. And again, the idea of power and voice is really the crux of a lot of what we're doing. We started out at trying to, with the big problem of narrowing the wealth gap. How do we eliminate that wealth gap? And to do so, it's not only bringing the founders and those who are starting the companies, supporting them and helping them get more prosperous, but it's also how do we build up the power and voice and wealth of the employees? How do we ensure them as far as the minimum or livable wages that we're looking at? How do we really help them gain strength of voice and initially or eventually some self-determination in there? Last.
This portion.
Sure.
And we'll bring it and then we'll come back.
We have like 2 slides and I'm done. It says 32, but it's not 32. Lastly, we're looking at with this portfolio, we're looking at real estate. In this, we came to understand that if you're talking about wealth, you're talking about narrowing gaps, if you're talking about supporting communities, you can't do so without addressing real estate. And what we're doing is we're really looking at how do we prevent anti-displacement? How do we keep neighborhoods looking like they have been, as opposed to being gentrified, as we know that there are, that's rapidly happening in a place, especially like Boston, where real estate costs are so high. How do we support tenant voice, and how do we support community ownership or community control of property, of land, and things of that nature? Things that we're interested in as far as our investment themes. Investment criteria. So we're looking at a few different things here. We're looking at economic justice. So who owns it? Who owns the opportunity? What are the opportunities? What kind of procurement do they do as far as with local and other smaller businesses? We're looking at the enterprise health. We're looking at governance and power. So what's the structure like? What are the checks and balances that are built in? Are the companies, do they have a board? Do they have, what kind of representations on their board? Is it well diversified? Things of that nature. And then climate resilience. All of these criteria are key criteria that we look at in evaluating any business that comes before us. And lastly, outcomes that we're looking for. Again, as we mentioned before, it's important to measure what you care about. So the outcomes we're looking for is increased wealth and asset building opportunities for communities of color. That's the first. Second, we want to grow social and political power for workers and employees. And I think that that's come across throughout, what we've been talking about. Innovation led by entrepreneurs of color is what we're looking to support. Climate resilience in communities of color and other vulnerable populations. And growth of democratically owned and governed businesses, including unions, worker-owned and cooperatively owned ventures. Those are the primary avenues that we're looking to measure the impact that the fund will have over time.
Henry,
Last,
we'll skip this because we said we're investing in New England, including upstate New York.
Right.
But I wanted to just go through 3 examples just to give you a little flavor of the kind of companies we're investing in. So Care Academy, Helen Edison, some of you may have heard of her. We invested in Helen very, very early when she was just starting out. Her company is called Care Academy. She creates online caregiving training. So it's video-based training for caregivers, for people that may be coming into your home to care for the elderly, your mom, your dad, and disabled individuals. A lot of them are not trained to care for people that have some serious health conditions. And so she started this company to do that. And when we invested in her, I forget how much, it was like a very small loan. And never did we think that she would grow this large and this quickly. Last year, she raised a $20 million Series A round. She's become one of the 100 Black women who have raised more than $1 million in venture capital. Because it used to be that there was a stat before, let's say 2020, that there were less than 100 Black women that had raised more than $1 million in venture. It's hard to believe, right? But that gives you a sense of how deep the capital gap is, especially in venture. And so this was a convertible note round, and we participated with that.
as a side note, 4 of them are in our portfolio.
That's right.
And they were in our portfolio at the very early stage before anyone knew them. Again, we invested in her way back when as a pre-seed, and now she just had this wonderful A round. So.
And she was training really locally, right? She was doing video-based training. She explored lots of things. So the Series A round helped her scale her company nation. This is another one. Chop Value is a very early stage company. Elaine Chow came to us. She had been in the nonprofit sector for a long time, and she came across this franchise technology, which takes chopsticks, so something that goes into landfills, And it's a micro manufacturing technology that allows you to compress these chopsticks into a very hard, sustainable wood. So she's producing furniture, like tables like this, beautiful home accessories, corporate, what do you call it, like
Gifts,
gifts.
corporate gifts, yeah.
And I wish we brought you some examples, but why we love this is, one, it's a circular economy company, taking waste and producing something sustainable out of it. The process is zero waste itself. She's right here in Charlestown. She's employing people from the community, and her goal is to eventually sell this company back to her employees, right? She wants to transition into employee ownership. So this is one because it's so early. She had some capital to put in, right? She was one of the few entrepreneurs we see with some significant savings to put towards the company, but it wasn't enough. And she needed equity, right, to start this. So we invested in what we call structured equity, meaning we made an investment across two funds, so $100,000 total, but we structured it so that by year 5, 6, 7, when she starts to ramp up her revenues and has enough profit, she's gonna buy this equity back from us at a cap. No VC will do this, right? But we're doing it because we want to benefit her and her employees who create value. And then last, this is, I don't, maybe we don't do this in the slide here. You want to do math talk?
Sure. Math Talk, another early company, based out of Cambridge. When he first came to us, it was an idea. His father's been in education for a very, very long time. The Moses are pretty well known in math circles. And when he came to us again, they did not have a fundable or investable business. So we told them, okay, well, let's see what it is that you do have. And we understood that they did have a good relationship with a lot of nonprofits at the time. And what we did is we were able to provide some nonprofit, some grant financing. So a nonprofit might give you, a 3-year pledge of 10, let's say $1 million every year for 3 years, or however much it may be. That's only available over that time frame. Well, we were able to look at them and say, okay, well, based on this pledge, we can give you an advance on that money, on some of that grant money. When it comes in, we'll get paid back, but you're able to do what you need to do to grow right now. Fast forward, so that was very, very early. They've done quite a bit of growing. He's hired an amazing staff, and they just had their Series A as well. They just had their first price round, again, over $1 million raised at a substantial valuation, doing very, very well. So the idea is that we're excited about some of these companies where we're able to make a difference in that founder and help with their trajectory. Also, in both of these cases, we made a lot of those early introductions to other capital sources so they can grow, and again, helping them with business development, with introductions, both to business opportunities, potential employees, and along the gamut. So again, it's not just capital that we're looking to bring. And that was it. Nope, that's it. And we could do Q&A at some point whenever.
Whole golden solution, this fresh new approach. Smart capital, versatile, investor, and really target friendly, but yet with a heart. So now let's look at the second fund like that spans, in fact, South Carolina to Boston. Delighted to welcome Anthony Kalambi to that high market capital. And then we'll come back to BII as well.
For money. Only one? No one else wants money.
We'll take some.
Everyone wants. Yeah, my name is, first of all, thank you for. My name is Kalambi, and my background is knowledge in software. Basically, my technology background. Couple of years back. We were project. Where you can. Support it. We're trying to take manufacturing. This is. Leveraging the power of. He did a football. Who used to be the chairman of. You can learn a little bit of the project. Get out of the creation. See if it. But fast forward, and I work to one the time. And almost. I will say it's technically it's large. It's $20 million fund. It is a fund which is focused on BIPOC. I guess it's kind of. I'm sure that. But our focus is on what we call steady businesses, basically like social and economic disadvantage.
The first time I heard about that term was through the minority business development agency, so I'm glad you're using it.
And maybe just so that a little bit about also, I think we should probably help you understand what the definition is.
Yeah, just take multiple cups.
So let's understand what this term "steady" is. Here we have defined term. So it talks about people who are. They're either owned or controlled by individuals who are in one of these categories. One is either they are a member of a group which is subject to some kind of racial or bias. Second is gender, third is veteran status, limited English proficiency, physical handicap, long time residence isolated from mainstream society, membership of a federally or state recognized unified, long-term residents in the rural community, residents in the US territory. You can read all the membership of an underserved community. So it's a very well defined term. And our focus is really on, first of all, to support companies and people who are of this. Our initial fund, so $20 million. This fund is being supported by Bank of America. We also have a partner for good growth capital. We're basically Herbert Baker is the managing partner. He himself is well known in the community, especially in the South Carolina. This fund has been funded in Charles. He comes from a medtech background, been a veteran, and he's done a number of things. Most importantly, he's a very active member of various So. Non-profit organization, one of them is called the Pussy. He's also a very well-known in the black community. He's part of the association, operation executives, he's done a lot of stuff. So that's the fund. It's a brand new fund. Just started, probably will be goes our first investment next 4 weeks. We have been talking to about 20 companies. There were a little bit about I'll give you a sense of what kind of companies they are. Would you like to cover by news or in this
Yes,
section?
yes, I think it was very interesting to hear the companies that have been funded, so certainly companies that you consider attractive enough to evaluate is a good baseline understanding, and then if you could end with the criteria, that'd be great.
So I'll probably give you the 5 big criteria that we have by evaluating businesses, and then of course, there are more questions. Currently, we are in these sectors. We are in communications, we are in digital transformation, we are in agri-tech, ed-tech, health tech, micro mobility, wearables, and this is a broad range, there are 15 to 20 companies. Most likely, our ticket size of investment will be in the region of about anywhere up to half a million range. We will be in seed, mostly in seed rounds. And there are a couple of companies that are a little advanced. In most cases, we are leading the round. Straight before investors to come join us. And we have this kind of close down. So that's a little bit of an introduction to time after. Questions before I take you a little further into investment bank.
Go ahead and do the question.
So there are 5 major criteria that we are planning. First is what we call leadership assessment. In the leadership assessment, it's essentially a, I'm sure you will read that it's the core team that defines everything. Some of the names that you saw just now. There are people who are individuals who have extremely competent, they have the background and experience sometimes, but most importantly, passion for the thing they do. But there's a fairly structured process that we have in terms of doing resumes, look at the proven track record in some cases, depending of course on the scale and size of the company. We also look at the core team that they have, and whether the team possesses the balance of experiences. So first of all is resumes. Second is professional references. And third is, especially if we're looking at any, if they already have a board, then we have to look at what that board looks like. So already a company. So that's the first step, which is the leadership assessment. That's probably the most important area for us to look at in investment. The second is we look at technology, IP, and product growth. So in this, we look at what is the description of technology, what kind of product is it? Are there any relevant technical publications? Are there patents? Right? Case? What kind of related intellectual property is there? Whether it is, related to things like, especially in the defense area, where the freedom to operate, those kind of issues that are an issue around that. What are the key milestones on the product roadmap? We built a product roadmap. what are the key milestones we are? And most importantly, what are the competing technologies? And what is the commercialization status? So that is the section on technology IP and product. Now, during this time, we talk to the technical team to understand whether the technical team is qualified and experienced. I'll give you an example of a team that didn't make it. Just to understand how didn't make it with us. Not sure that didn't make it with us. There's a very enterprising person who came to us, saying that they want to launch a drone-based system service to help monitor assets in the utility assets. Utility assets as in transmission lines, those kind. So excellent profile. So they met the leadership assessment very well. The person had excellent background in terms of drone knowledge of drones, how to operate drones, certified pilot, etc. Where they faltered was that they had created a technology where they wanted to say that they had a plan to do a completely autonomous way of managing this whole surveillance and data collection. And they have not really thought has been done equally, right? There is no one that understood this number. Aspect of that was really good. The other aspect of it was not. Now, it's not that the person is completely out. All they decided is that they want to find someone who really understands autonomous power, and then club that person, whether it could be an individual or it could be a company, club that person with this company, and then figure out how to fund it. But at this point, they are not really fundable because they are that very critical piece of what they want to do. It's not there in the competence, the zone of competence of this. That doesn't mean, and I don't want to dampen it. I just want to give you, when you go in pitching, and I don't want to give you a totally rosy picture that will be questioned on many of these topics, so you have to be ready as you build your plan on all these issues. The third thing, which is, and this may not be relevant everywhere, but in certain sectors, the regulated. If you are in a regulated sector, then you have a regulated, you understand first of all what is the regulatory framework. For example, in Rome, there's a regulatory framework. So, and what is, if you are in a regulator, if you're a medtech, for example, that would be regulated. What is the current status of your dialogue on the regulator? You're developing something which is going to be FDA approved, then where are you in that process of going through that approval? And that's a pretty long process. The third is customer need and your go-to-market. This is where I think a lot of companies really struggle because technologists are great at understanding what they want to do, but how do you take it to market and to be successful? How do you price your product? What is your public model? Get your product out and sell it to the target audience. What is your competitive analysis? Because of how you manage that. Those are some things that you have in your plan. Fairly early. What we do here is essentially you already have a sales team, and yes, you're still very early in the startup, then we coach you and mentor you in terms of how to build that to the market. A lot of technology people who come in very early, they know this is a blind spot. There are people who come from that domain, that is their strength. Many of the people who are starting up a company, they're starting with a big idea with a technology in their mind, so they don't still have that experience of thinking with the market. And this is where we work with entrepreneurs to figure that out. So, for example, we have investing in a cybersecurity company. It's a cybersecurity training company. It's a technology that is well established, but needs proper go-to-market. So there is no problem about the first two aspects. The leadership team is very good. The technology IP is solid. Resourcing the technology from probably the best possible place. Where they have it, choose how they will price, how they will find, and how they will improve the sustainability. All of this, finally, we're trying to build something which is of scale. Any startup start the important reason to if you want to go really big at some point, right? You're addressing a big market. And understanding that market size, what that market opportunity is, having market estimates from some reliable source, gathering that data from market, assessing that product market fit, all that is a part of what we call market sizing. That is the fourth criteria of figuring out how the plan is done. And the last, which I think, again, this is where there is not that much of skill in many entrepreneurs, so that's where we come into is their financial projections and their funding strategy. What's going to be the projected financials for the next years. It may be too early to talk about exits, but we need to think a little bit about where we will be taking the company. So these are the 5 major criteria on which we assess go to fairly 5 of us, we said do our independent evaluations, and then we converge and pair our ratings and we roll them up, and then we have an investment committee meeting to decide whether we want to go forward. Questions? Would that help?
Great, yes. No, very well. Questions? Observations?
Yes, me.
Please identify yourself.
John, non-tax. How do you guys basically raise your funds? Do you raise your funds basically from, let's say, your financially well, or do you do, as you said, employee-based fundraising in that situation? And that's for both.
So our fund is a debt fund.
Yeah.
And it is in our capital market, it's what we call it, impact first fund, which financially means it's below market rate to you as the investor. So when you invest in our fund, we have 3 classes of notes. One is for wealthy individuals. So it's a 10-year note at 3%. So your return is 3%. If you're more philanthropically inclined, like a foundation, you might put in the philanthropic note, it's a 10-year 1%. So you're really looking just to preserve your money and to have an impact with your charitable dollars. And then BII can do this because we're a nonprofit, and our fund is structured as a charitable loan fund. So we also have an investment opportunity for people that are not wealthy, ordinary people that don't meet that accredited investor definition. And that's a 5-year 5% note, which if you renew it again for 5 years, it's 7%. So the thing to keep in mind is that when our investors are investing in BII, more for the impact return. So this is like a shift in mindset, right? Where you're making investments sometimes just to make money, and that's okay. But we're saying, hey, if we want to shift our economy, right, to move it more towards solidarity, we also have to invest in income. And so we're balancing the two. So our investors allow us then to deploy our capital. So those investments we talked about, right? When we talk about buying, the structured equity, letting the business buy the equity back, or our loans right now are really favorable terms. Like right now, our debt is at 5 to 7%. Right? Bank, if you go to a bank, it's upwards almost at 10. So we're offering very entrepreneur-friendly capital. So, yeah. But you know, the fundraising right now is challenging. The entire market, I don't know if you're experiencing this, but and because we also work with emerging fund managers, and everyone is having a harder time to fundraising for their funds, especially small funds, micro funds. Funds below 50 million are called micro. But it's a good question. Great.
Andy, how about you?
Yeah, so we have three categories of, three money into our funds for things. One is banks, Bank of America. And, banks need to do it because they have a commitment to invest. Especially category of investment that they need to do. So that's, the second is, have, state, so the state of South Carolina. One third of the fund is, funds to the. The third is family. Where the fund of family offices.
Do you, on the state, is it coming out of the treasury money, like the SMPCR? You know,
I would need to check because other hand is best. Maybe on the call, if you line the call.
But for some of you, so you can tell the difference. So you're a traditional equity fund, right? Where you have a general partner and then limited partners are these investors, so the banks, the family offices, right? So we don't have LPs or DPs, but similar, like we can raise money from family offices, wealthy individuals, foundations, even anchor institutions like universities. Hospital.
Yeah. Or, as I said, you, if you dive into that.
Let me turn a question to the audience here. What do we do to see? I mean, we saw two very interesting descriptions. Funds that are non-traditional in terms of the populations they are focusing on, and in certain cases, the methodologies they're employing to determine who should get the investment. I'm curious from your perspective and the audience, what is the difference that you detect, if any, between the two funds? Not a good question. Is there a difference? Do you perceive, Andy, do you perceive a difference in your approach to BIS? That's why I was curious. I mean, see if the audience picked up.
Yeah, it seems like they do it more, they choose, first they do a loan situation for their small businesses, and then they decide to do equity investments in those small businesses. And this gentleman right here, since he's with the banks, which usually banks need more secure situations, you have to pass certain criteria to that situation. You know, that's what I got.
Okay, would you say that's true, that your concession that you're making is looking at the steady and the group, which is underserved? Once they are admissible in the group, you are pretty much applying so-called more traditional benchmarks to see whether this business has the legs to succeed or not. Correct? Right. Compare that to BII. BII also wants entrepreneurial success, but what's the difference? You notice the versatility in the range of instruments that they're willing to use, which in turn gives the entrepreneur more time to grow So I'm just not speaking to you. I just want you to understand, I want to understand that one seems to be very, very focused on the community and in this case, the local community and the person who is driving it. So is Highmark. So is Highmark. But Highmark, at least from Andy's initial description, expects the business to have jumped to a few more preparedness hoops. Is that correct?
To some extent, I'd say yes. I mean, we do a lot of rigorous analysis of business prospects as well. However, it's very clear where it's good that the crowd got the difference of different types of companies that would go to a Highmark versus BIR. We may invest in some of the same companies, but I think there's a wider range of companies that BII might look at from that perspective, for example, where that's not the market that Highmark serves.
And would you say the check size may be smaller or different? What do you expect your check size?
Our check sizes currently are anywhere from 50K.
Okay, that sounds
In our
similar
case,
to you.
Yeah, 102.
I would say also one more thing, so. I think our definition. Fact is, it doesn't matter what the
We're more, this fund is more rigorous than the first one, than our first one, yeah.
For us, we are only.
Define social wealth. So that was a very, very, quite unusual. Please go ahead.
The only filter that we have is that you should be part of that category. Other than that, it's a regular business. And it's really a traditional way of investing into venture capital investment. The important thing, of course, is that make them successful because they come from these disadvantaged communities. There is a need to put in a little more effort in terms of mentoring, coaching, and so the scaffolding that is needed to keep that business, to bring that business up. So towards that, we are putting in a lot more effort, bringing in specialists to help them take them through that. So, I'm simply right. And my question is that what kind of returns are you expecting and for what time?
First, it really depends on the type of investment. So, if we're making a loan, again, our rates right around 5, 6, 7%. For our structured equity products, it may be where we're looking to get, right now, prime is at 8, so we might be looking at 10, 12% for a structured equity product, where traditional equity you would have much, much higher expectations. 2x, 10x in these cases are the expectations. Our focus is what's our cost of capital? What's our cost to run the fund? And then beyond that, to ensure the health of the portfolio so that our investors are paid back. And then we want to have the bulk of the value that you're creating as an entrepreneur go back to you and the employees. So it is where we are capping our rates for structured equity products, where even in products where it's not a structured exit, but it's regular exit with the regular VC led cohort, where we're trying to understand how do we align ourselves with entrepreneur in any such exit situation where they can buy us out directly and they participate most of us. Because again, we're, if we come in at a convertible at 20% discount to the price round. So when the price round happens, we already made 20%. We're happy.
Yeah, and just on equity, right, where we probably would cap our returns at 3x. So say you built an amazing business, you're gonna have an exit. I know, and that sounds like we have these struggles and things like, why don't we take the whole thing that we're entitled to? Part of it is and this hasn't happened yet. We haven't had this situation come up. We will soon. And it'll be a test, right, for us in that we look at the impact of this business. the more impactful it is from a, you know, environmental, governance, power perspective, employee power, et cetera, the less of a return, financial return will, right? And that, I know, like, you might do that, but it's because we're trying to redistribute that wealth back to the founders of the employee. Now, if we can't, right, if it's a situation where, for some reason, we can't get that profit back to where it should go, then we will take it. And we'll plow it back into BII, right, for either our programmatic work or to sustain the fund. But our goal is not to extract as much of the profit as possible, but rather to. And again, that's part of our nonprofit.
So follow-up question to that. Well, investing in startups are very easy. Yeah. So you are in a $10 million fund, invest in enterprises, say 20%, so 30%.
Yeah.
So how do you manage the risk given that there is a gap on the return that you are?
I mean, that's the complicated modeling.
Yeah, it's really, you know, the management portfolio, so we have, how much of the portfolio is going to be in debt? The risk profile, how much of it is going to be structured, which is again, a different risk profile, how much of it is going to be in traditional equity, which has that higher, default. And then going forward with all of that, how do we manage some of that risk? And that's the hard part.
So there's, I think there's, what you said yesterday, 24% loss rate though. And we manage that with the investing staff, or the capital staff, right? So when we mentioned we have these philanthropic nodes, below that, there's also what we call, because we can raise recoverable grants also. Recoverable grants don't have to be paid back, can't pay them back. So we've built in layers of cushion to protect those, you know, the other investors of that.
Yeah, I think traditional VC funds have an IRR of about 25%. That's the usual. There are no questions I can ask them. What kind of stakes are you taking? I'll let you first answer.
It totally depends, right? Because, like with top value, we owns the whole of the company, our stake is like fairly small. Yeah, so we don't take majority stakes because that then would affect, a lot of these companies are also certified as minority business enterprises or women business enterprises, so you don't want to mess up their status. So we never take more than that, but again, we are not, equity is hard for us because we know it's needed by companies, like can't have a ton of debt on your balance sheet, you need some equity, but our goal is not to take an ownership stake in a significant amount, so it could probably range like maybe 10 to 15, I'm not biased, and we're often not the lead. Occasionally, we're leading or helping set terms, but we're often not the lead investor. We partner a lot with co-investors, so we have a whole group of impact investors that we work with. We co-invest together, and more we invest with CDFI. Like CDFI is community development finance institutions. Sorry, I can get my acronym straight today. Most CDFIs lend, but some of them want to start doing more equity, and we're teaching them. So, for example, Cooperative Fund of New England invests in cooperative businesses, and we're working together to invest equity in these businesses, and they're learning from them. So, we have a bigger mission to change the money moves, to not have these bifurcations, right? So even in a venture fund, when you look at like what happens to Silicon Valley Bank, like even though venture funds are doing equity investments, a lot of these companies need debt as well. So we're able to put all kinds of capital types, and it's not always about the stakes you have.
Yeah, we'll always take a minority stake. The stake depends on the valuation, what's the money required. How much of this, how many players are there? It's hard to say what exact percentage. But what I want to say is that for my background, I've never mentioned the how right. One of the places where one get into trouble is when you don't manage that properly. They get diluted. And then eventually, I don't lose interest or lose stake. But that needs to be managed carefully. With everyone. The temptation always to maximize your I think what's important is to manage the capital and equitability. You are running the company. So it was also a section. First, we always take a moment. Second is stake really depends on valuation. The third is that every stage the capital needs to be looked at carefully so that we end up with what is called a new work.
Very good advice. Let me tell you from an entrepreneur's perspective, generally, if you have yielded around 30% in your seed round, you're kind of pop. That's pop. If you've done better than that, I mean, you've yielded less in the 20s, you're kind of doing well. And if you've given up half your company before you record your first round, generally that means, you've got a longer road. Sometimes that may still make sense, but so that seems to be the general pattern for BII to take 10, and that's very, very investor friendly. That's extremely investor. Yeah, I mean, on. Yeah. So, any other general queries? Any of you may have over here may have early ideas about the company or early ideas about ventures. Any discussion you want to have on that? This is also good face-to-face questions.
What do you look at in regards to the financial background of the company? So let's say you have a startup. What are you looking at in your books? What are you, are they developing? Are you looking more at the idea of the potential to bring into market? Or are you looking at what they've done in the past with regards to potentials of profits, or even if they've broken even?
I would say that it really depends on the company and really depends on the opportunity. So you mentioned startup, but the implication in the question is that there's operations that have been already. They're not a pure startup.
Yeah.
They either have customers or revenue. What I'm looking at, I'm really looking for at the stage, whatever stage you are, what's the need going forward from a financial perspective? What's the objective that the entrepreneur has? What are you looking to do as far as going forward? And do you have the right people in place? Do you have a plan in place to get to where you're going? How much will it cost for you to get there? And how will we be able to be supported in that plan? Can we play a role there? Now, part of all of that analysis is also determining, well, who else is in the space? Who are the competitors? What have you considered those obstacles? Is what you're doing defendable to a certain extent? And again, it really is. Your question is very company specific.
Yeah.
So it really depends on what the terms are for that specific transaction you're looking at. And then, it is because it could be where revenue growth is important, where some others, it may be where it's not necessarily revenue growth, but it's customer acquisition, regardless of revenue at that point. The others, it may be where it's, we're not even talking revenues yet. It's, you know, the developments of the business and, you know, what kind of IP they have. So, you know, there's a lot of different things that we consider when we look at a business.
I think, and maybe what you were getting at is when do we come in? So we typically come in when there's a little bit of some traction. There's a handful that we invested in before they even opened, but there was a plan. And the plan was very clear, right? So like Chop Valley, when we invested, didn't have space yet. Didn't, you know, was looking for space, they knew exactly what they were gonna do, how much it's gonna cost to start. So we're really there to start it up. And we have a few like that, but those are the early stage ones. With debt, you have to have cash, right? So those are established businesses, they're still young, they're early enough that they can't get bank debt. You have to typically be in operations for 2 years before you get a loan from the bank. Right, so those early years, no one's gonna give you a loan, you know, very hard to get a loan, and you're putting up like a lot of your personal collateral, right? And so those have started up, there's a market, there's cash, sometimes it's inconsistent, so we might be doing royalty or receivable financing or, you know, other financing to help meet that cash flow issue. A lot of businesses too right now need working capital. They're getting contracts, right? They have like the business, but they can't execute on the contract without cash. Right, so before, because they haven't been paid yet, so we also do like credit or. So it raises, what we won't do is, if you've gotten to the point like Care Academy, if they raise another round, Series B, we won't invest it, because they don't need it then. Right, they're at the point where they can get other capital, they now have venture capitalization. We are not the right capital type anymore. So at that point, we're done. And we're looking to get out.
Yeah, that's the interesting
Yeah.
thing is that, you know, let's say, you're investing at a certain growth level too, so.
Yeah.
It can't be like too big, like.
Right.
It can't be like like when Tesla was growing big, you know.
We're a small fund, so we don't have
Right.
capacity at that point to bring the capital that they need to bear at that round. So early on, when they're looking to raise the first few $100,000, first $2 million, series round, I mean, seed round, Series A, maybe Series B, we'll invest in them, but sometimes you get into Series C round, and minimum investment size for any investor is $3 million. Well, that's well above where we're looking to invest.
Yeah.
So, just, you know, we're early investors, so that's our lane, if you will, where, there's other investors who come in at those later stages and help them to.
And again, we're supporting like middle market, like moderate growth businesses. There, a few will, you know, will grow, they'll become venture backable, but we're trying to fill a need in the market that currently very, very like.
There's a bulge of funds that will give you money when you don't need it. Ton of people will run after you to give you money when you don't need it. It's still useful, you still need the money, but these funds are filling a gap at the earliest stage. So we have only a couple of minutes left. I'm going to give it to each of them to give a sort of a final comment. What I wanted to tell you regarding the Venture Development Center itself and our mandate, hopefully you glean from these funds, and we've implied that they take a somewhat more kindly approach perhaps to the entrepreneur. Even to pass muster with any fund, needed straight in the forefront preparation and work. You know, it's not a joke to raise money, period. People are ultimately looking at your face, you're printing money in effect, because you're creating stock in a company, and they're looking at you, they're accepting your printed money, and they're taking a bet on it. So you can imagine that they expect you to be very well prepared. And that's, by the way, where the Venture Development Center comes in. And so as your ideas begin to fructify, as you will find resources here, opportunities here to refine those ideas, to get ready for competition. get those ideas ready for the light of day so that they can meet with a positive assessment. Okay, so that's the way to piece all of this together. It's the place where you get prepared. And then these are avenues where once you're prepared, you may meet a kindly reception. So with that, let me do Andy, your thoughts, any final comment you want to make?
Well, I think you're in a great place here. in my question. Thanks. What I'd like to say is what my experience in the life. One is from like you said, compared to and you facilitated that process because I talked about it. For this group who potentially investing. The second is really the mindset. It should be not about raising money, but returning money. Investors, people are looking at what will come back. So sometimes entrepreneurs are so focused on just raising capital, raising the money is really the win. Actually, the raising money is not good. The fact is that we're returning money. Right, so it's important to think about how the money will be returned as you're raising it. That would probably lead to a better conversation with investors.
So I would say investors, are like a marriage, right? So as an entrepreneur and investor, you're looking for investors that understand what you're doing, understand the industry, that also have the right kind of capital for you, right, at the time that we're raising. And that will change over time. We look at it as very much a motivation. So, I would encourage all of you as you're building out your business ideas is meet different investors that you get like, right? Don't seek money first, but rather ask for input, ask for guidance, ask for advice, and and also be willing to pivot, be willing to be flexible and perhaps change. What I would say about BII is that we do a lot of mentoring, coaching, pre-investment preparation. Sometimes we're in the business for a year before that's like almost, right? We were with them for a very long time before we actually made an investment. We did grant receivable financing and then later after invested. And part of that was helping him see through the idea, right? And forging connections for him. So one of the things that we will also push on, which maybe this all has to do with what you care about, right? We're looking for impact as well. So if you're like, I want to learn how to build my business so that it is going to drive impact, it's going to be sustainable, but it's going to do these other things. Like I want to start looking at my employee base. I want to maybe perhaps, shift my business ultimately to be employee owned, or I want to, create a different supply chain, right? Or I want to build out a new model for this industry that hasn't seen yet. We will go down that journey because we're really trying to shift systems, kind of change traditional ways of doing things that have not benefited our most underserved communities. So we will help go on the journey with anybody wants.
That's really well said. Thank you. Agreed?
As Betty mentioned, relationships, start them early, start them often, get to know us, let us get to know you. And get out there, talk to people. It only refines what it is that you're looking to do. And as Betty mentioned, before you're looking for money, look to build those relationships. It will come very, very useful in the future.
Terrific. Well, thank you. Thank you, Henry. Thank you, Betty, and thank you, Andy. Very exciting afternoon. And I hope you all took away a lot. By the way, the reason I asked, we also speak to posterity. This is going to go into our repository. This will be replayed and be potentially used. So there's life after this. That's one important thing. So Bala, as the boss of all of this, do you have any comment to add as we end this?
Add anything to what's been said and done? Fantastic.
it ends, and I hope the students here, I mean, this is, the VDC is your Center for Translational Education. So if you interact with us and come to these events and this is a place to meet each other and meet others and you know, get more of your education, more from your education. Yes, so please spread the word with other students and faculty. The pandemic has hurt traffic a bit, so we want to get out there, and, you know, we are revamping a lot of this. So, please do let people know, about what you experienced, and also, please stay around for cookies and, a few other little goodies that we put out here. So thank you all very much.
Well, thank you for reporting.
Yeah. Yeah,
But we-
Thank you. Nice to see you.
Yeah, you guys need to.
yeah, that's-
I still have a little bit more time. But yeah, because you did it. I didn't go. Yeah, I gotta figure it out.
I actually go. Around there,
Yeah, so it's like.
they were, yeah. Or we think on LinkedIn, we've spoken a few times. What's interesting about it, they're pretty recent as far as the fund.
Yeah.
Yeah.
They have to be- they have to-
What was interesting though is they got, you know, 30 of their money from banks. Sharing all their seats. They're sharing those.
Yeah.
ERA, yeah.
That's been sitting a lot of things.
Like, that's why we're applying to be.
Remember, they're a CDFI as well.
This type,
Well, they're part of CDBCA, so maybe they're on their way out.
you're gonna become a.